Good morning, grade 12 ABMB. Are you ready to learn another topic in fundamental of accountancy, business and management too? Now, we will be going to present our video presentation about analysis and interpretation of financial statement. At the end of this lesson, you should be able to analyze what financial statement is, analyze financial statement horizontally, and analyze financial statement vertically. The table of contents of this video presentation: first, analysis of financial statement; second, traditionally financial statement analysis, which includes the liquidity, solvency, stability, profitability, and efficiency; fourth, horizontal analysis, definition and example; and the last one is vertical analysis, definition and example. Business owners are busy with the day-to-day operation of running a business to the extent of ignoring any company financial statement analysis. In general, an analysis of financial statement is a vital for person running a business because this analysis tells the business owners where they stand in their financial environment. Now, let's have Miss Alian Judoko to discuss the financial analysis state.
Analysis of financial statement. Analysis of financial statement is the selection, evaluation, and interpretation of financial statements data, along with other pertinent information to assist in investment and financial decision making and to show how and where to improve the performance of the business. It means that analyzing financial statements means carefully looking at a company's financial statements data and other relevant information. Through this, dako talaga ang nabubulig niya pagdatong sa investing and financial decisions nga naipapakita kung diin and paano mai-improve ang performance sa sayo nga business. The analysis of financial statements involves examining data from financial statements and other relevant information to aid in making investments and financial decisions. It helps identify areas for improvement in a business performance by evaluating and interpreting financial data. Essentially, it's a process that provides insights into the financial health of a company and guides decisions to enhance its overall effectiveness.
The analysis of financial statements is an evaluation of a firm's past financial performance, evaluate present financial results, its prospects for the future. First up, let's talk about the past. By looking at a company's historical financial statements, such as income statements and balance sheets, we can see how well it has performed in the past. This includes understanding its profits, losses, assets, and liabilities over a specific period, like a year or more. Now let's shift our focus to the present. Analyzing a company's current financial statements gives us a snapshot of its current financial health. We'll look at things like its current profitability, how much cash it has on hand, and overall financial stability. Lastly, we'll explore the crystal ball of financial predicting the future. By considering trends, market conditions, and companies' strategies, we can make informed guesses about its potential growth or challenges ahead. This helps investors and stakeholders make smart decisions about the company's future. Analyzing financial statements is like reading a financial storybook. We learn about company's past, understand its present situation, and try to predict what might happen in the exciting chapters to come. It's like a valuable tool for making informed decisions in the world of finance. Business owners can use company financial analysis both internally and externally. They can use them internally to examine issues such as employee performance, the efficiency of operations, and credit policies. For example, there's a small ice cream shop owner using financial analysis. An employee performance, the owner looks at the financial numbers to see which ice cream flavor are selling the most. If chocolate is the best seller, they might praise the employee in charge of chocolate production. In the efficiency of operations, let's say by checking the cost and sales, the owner can figure out if there are ways to make the ice cream making process smoother and more cost effective. In credit policies, if the shop allows customers to buy ice cream on credit, the owner might use financial analysis to see if this policy is working well or if adjustments are needed. They can also use them externally to examine potential investments and creditworthiness of borrowers, among other things. For example, in potential investments, let's say a owner is thinking about opening a second shop. They would analyze the financial potential by looking at the cost, expected profits, and risk involved. In creditworthiness of borrowers, let's say if someone asks to borrow money to start their own ice cream stand, the owner can use financial analysis to check if this person is likely to pay back the borrowed money based on their financial history.
Most importantly, financial analysis points to the financial destination of the business in both the near future and to its long term trends. So, financial analysis serves as a compass for a business. Kaya para sa compass, financial analysis guides us towards understanding kung diin nahihingain ang company's finances, both in short term and the long term. And also, aside from compass, you can also think of financial analysis as a roadmap for a business money journey. Kasi just like what I have said, it helps us predict where the business is headed in the short term and over the long term. It shows us the future trends and destinations of the company's money matters.
Analysis can also show a firm's liquidity, debts, and profitability. It can also show how investors perceive the firm. It can likewise help detect emerging problems and strengths. Looking at a company's number can tell us a few important things. We can see if it has enough money for short-term needs, understand how it's dealing with debts, and figure out if it's making money. We can also check how investors feel about the company by looking at things like stock prices, and by analyzing the numbers we can spot potential issues coming up and identifying what the company is really good at.
Besides analyzing the past performance, analysis helps determine the strategy of a company in order to move forward. So, financial analysis is like looking at the past performance to understand how well it did in the past. Kasi the past performance of the company can help the company plan for the future. Kasi 'di ba, by analyzing the past performance, makikita mo kung nano ang nag-work from the past and what didn't. By that, the company can decide on a smart strategy to do even better to move forward.
Good day everyone, I'm Siena Francis Maraco. I'm here to discuss measurement levels. Measurement levels means financial ratios are one of the most common tools of managerial decision making. A ratio is a comparison of one number to another mathematically, a simple division problem. Financial ratios involve the comparison of various figures from the financial statements in order to gain information about the company's performance. It is the interpretation rather than the calculation that makes financial ratios a useful tool for business managers. Ratios may serve as indicators, clues, or red flags regarding net worth, relationship between variables used to measure the firm's performance in terms of profitability, asset utilization, liquidity, leverage, or market valuation. Measurement levels in the analysis and interpretation of financial statements refer to the different scales or levels of measurement used to quantify and classify financial data. There are four commonly recognized measurement levels. Now we have the nominal scales. This is the simplest level of measurement where data is categorized into distinct categories or groups. Examples include classifying expenses into different categories like salaries, rent, or utilities. Two ordinal scales. In this label, data is ranked or ordered based on a certain attribute or characteristic. However, the differences between the ranks are not quantifiable. An example would be ranking customer satisfaction level as high, medium, or low. 3. Interval scales. This label of measurement not only ranks the data but also measures the differences between the values. However, there is no true 0 point. An example would be measuring temperature in degree Celsius. Number 4 is ratio scales. This is the highest level of measurements, which includes all the characteristics of the previous levels. It is not only ranks measure differences but also has a true 0 point. Examples includes financial ratios like return on investments (ROI) or earnings per share (EPS). These measurements levels help in analyzing and interpreting financial statements by providing a framework for understanding the nature and significance of the data. They assist in making meaningful comparisons, identifying trends, and drawing conclusions about the financial performance of a company.
Traditionally, financial statements analysis focuses on the following key areas: liquidity, solvency, stability, profitability, and efficiency.
Liquidity measures a company's ability to meet short-term financial obligations and pay its bills on time. Liquidity refers to a company's ability to meet its short-term financial obligations such as paying bills and debts. Nabanggit kanina nga ang current ratio is a common measure of liquidity. Here, compare ang company's current assets like cash, inventory, and accounts receivable to its current liabilities such as short-term debts and bills due within a year. If ang current ratio is greater than 1, ibig sabihin ang company is own enough current assets para makover ang current liabilities. This is generally considered the minimum acceptable level. However, if ang ratio naman is less than 1, the company has more liabilities than assets, which can be a cause for concern. A higher current ratio indicates a stronger financial position and more flexibility. Ibig sabihin, company has a safety caution because some of its assets may not be easily converted into cash. To improve the current ratio, a company can take steps like paying off debts, converting short-term debts into long-term ones, collecting money owed to them more quickly, and buying inventory only when necessary. In simple terms, an current ratio helps us understand if a company has enough resources para mabayaran ang bills on time. And the higher ratio is better as it means na a company is stronger financially. Solvency ratios indicates a company's financial stability by examining its debt relative to its asset and equity. Solvency ratios help us understand the company's financial stability by looking at its debt in relation to its assets and equity. If a company has too much debt, it may face difficulties managing its cash flow if interest rates increase or if business conditions worsen. There are two common solvency ratios: the debt to asset ratio and debt to equity ratio. The debt to asset ratio compares a company's total debt to its total assets. This ratio tells us how much of the company's assets are financed by debt. A higher ratio means a larger portion of the company's assets are funded by debt, which can be a sign of financial risk. The debt to equity ratio compares the company's total debt to its shareholders' equity. Shareholders' equity is the difference between the company's total assets and total liabilities. This ratio helps us understand the proportion of debt relative to the company's ownership or equity. A higher debt to equity ratios indicates a higher level of debt compared to the company's equity, which can also be a cause for concern. In simple terms, solvency ratios tell us how much debt a company has in relation to its assets and equity. If a company has too much debt, pwedeng mag-struggle ang company to manage its finances in challenging situations. It's generally better for a company to have lower solvency ratios, indicating a healthier financial position with less reliance on debt. Stability analysis investigates the long-term financial health of a company, assessing its ability to handle debt and maintain a balanced debt-to-equity ratio. Stability Stability is a concept that looks at the long-term financial health of a company, and it complements the idea of liquidity, which focuses on short-term financial obligations. Analysis helps us understand how much debt a company can handle and whether debt and equity are balanced. On common stability ratios, debt to equity ratio and gearing, also known as leverage. Sa debt to equity ratio, compare ang company's total debt sa shareholders' equity. It tells us kung how much debt the company has in relation to its own ownership or equity. A higher ratio indicates a higher level of debt compared to the company's equity, which can be a sign of financial risk. Gearing or leverage is another stability ratio that looks at the proportion of debt in company's capital structures. It measures how much debt is used to finance a company's operations compared to equity. A higher gearing ratio means a larger portion of the company's capital is funded by debt, which can increase financial risk. In simple terms, stability analysis helps us understand the long-term financial strength of a company. Inkukulawan kung how much debt ang kaya mahandle sa company and if balance ba ang debt and equity. A lower debt to equity ratio and moderate gearing ratio are generally considered more stable, indicating a healthier financial position for the company. That's it for my part. Profitability and efficiency will be discussed by Eliza. Thank you.
I'm going to discuss about profitability and efficiency. Profitability ratio indicates management ability to convert sales into profit and cash flows. May are three common ratio and profitability, and that is gross margin, operating margin, and net income margin. Ang gross margin is the ratio of gross profit sa sales. Sila ang nagme-measure sa profitability sa company by comparing sa net sales. Ang operating margin naman is kung pira ang profit na nahimo sa company after paying sa production ngan raw materials. Ang net income margin man is the net income sa sales. Ang net income is same sa operating profit minus la ang interest ngan taxes. Mayaon to ratio ang net income, and that is the return of assets ratio and the return on investment ratio. Ang return of assets ratio is ang total sa asset. Siya ang nag-measure kung paano ka-effective ang pag-deploy assets to generate profit. Ang return on investment ratio naman is ratio to shareholders' equity na nag-i-indicate sa ability sa company to generate returns pakadto sa owners. Next, efficiency. Mayaon to common efficiency ratio, and that is inventory turnover and receivable turnover. Inventory turnover is siya ang ratio sa cost of goods sold to inventory. Kapag dako ang inventory turnover, meaning successful ang pag-convert niya into sales. Ang receivable turnover, siya ang ratio of graded sales to account receivable. It used to collect utang ngan pag-extend sa credit. Kapag high ang ratio sa receivable turnover, meaning maupay ang pag-manage sa customer credit sa company.
Hello everyone, I am Jovin Concordia and I will discuss the horizontal and vertical analysis of financial statements. Horizontal and vertical analysis are two common methods used to analyze financial statements and gain insights into a company's financial performance. Here's an explanation of each. So what's horizontal analysis? Horizontal analysis, it analyzes the trend of the company's financial over a period of time. Each line item shows the percentage change from the previous method. Horizontal analysis, also known as a trend analysis, involves comparing financial statement data across multiple periods to identify changes and trends. It focuses on the dollar or percentage change in line items over time. By comparing the absolute changes or percentage change, horizontal analysis helps in understanding the direction and magnitude of the change. Horizontal analysis allows for the identification of patterns, seasonality, and trends in financial data. It helps in evaluating the company's performance over time and making informed decisions based on the observed trends. Now let's talk about the vertical analysis. Vertical analysis, it compares the relationship between a single item on the financial statements to the total transactions within one given period. It also shows the percentage of change since the last period. It can be performed on both an income statement and the balance sheet. Vertical analysis, also known as common size analysis, involves comparing each item on a financial statement to a base amount. The base amount is usually the total revenue or net sales for the income statement and total assets for the balance sheet by expressing each line item as a percentage of the base amount. Vertical analysis allows for an easy comparison and identification of trends over time. Vertical analysis helps to identify changes in the composition of financial statements, such as the proportion of expenses to revenue or the proportion of assets financed by debt. It allows for meaningful comparisons between different periods or companies of different sizes. So, both vertical and horizontal analysis provide valuable insights into a company's financial statements and help in understanding its financial health and performance over time. That's all. Thank you.
Horizontal analysis. Horizontal analysis is the comparison of historical financial information over a series of reporting periods, or of the ratios derived from the financial information. The intent is to see if any numbers are unusually high or low in a comparison to the information for bracketing periods, which may then trigger a detailed investigation of the reason for the difference. The analysis is most commonly a simple grouping of information that is sorted by period, but the numbers in each succeeding period can also be expressed as a percentage of the amount in the baseline year, with the baseline amount being listed as 100%. In the picture shows the format of horizontal analysis, which is horizontally, and the content is the transaction, current year, prior year, peso change, and percentage change. The goal of horizontal analysis is to see the changes or compare the changes every year or period by period, and to see also the reason why the transaction decrease or increase in current year and prior year. When conducting a horizontal analysis, it is useful to conduct the analysis for all of the financial statement at the same time, so that the complete impact of operational result on a company financial condition over the review period can be seen. A variation to the horizontal analysis is trend analysis. Under a trend analysis, the comparison of financial information extends beyond 2 periods, normally 5 or more. The computational procedure in a trend analysis are similar to a horizontal analysis. In short, horizontal analysis is very important or useful in a business to see the difference or the financial status of a business period by period, or to see also the growth of the business. So here is the formula of horizontal analysis. To get the variance, peso change is equal to current year minus prior year. To get the percentage change is equal to peso change divide prior year. To check your answer, prior year times percentage change and prior year plus peso change. So let's have an example. A horizontal analysis of the income statement. Below are the income statement information for the years December 31, 2015 and December 31, 2016 of RIA Merchandising Enterprises and the corresponding horizontal analysis and interpretation. So in the example, we can see the current year, prior year, the variance or peso change, and the percentage change. So in the next slide, we will show the solution. So in the sales of the income statement of RIA's merchandising, to get the variance, peso change is equal to current year minus prior year. The sales of RIA's merchandising in current year is 3 million, while in the prior year, 2,500,000. So to get the peso change, 3 million minus 2,500,000 is equal to 500,000. So the peso change of RIA merchandising in sales is 500,000 pesos. In the percentage change is equal to peso change divide prior year. So the peso change, which is the 500,000, you will divide it in the prior year. 500,000 divided by 2,500,000 is equal to 0.2, and multiply it to 100 is equal to 20, and put the percentage sign, which is the percentage change is equal to 20%. So that is the sales in RIA's merchandising. The peso change is 500,000 and the percentage change is 20,000. And to check if the peso change and the percentage change is correct, here is the solution. Prior year times percentage change, which is 2,500,000 times 20% is equal to 500,000, which is the amount change. And prior year plus peso change, which is 2,500,000 plus 500,000 is equal to 3 million, which is the current year. And guys, take note in checking if the peso change is negative, you will subtract prior year and peso change. In RIA's merchandising, we just solve one, which is the sales, because same lang naman lahat ng process or same lang yung formula para makuha ang peso change and percentage change ng ibang transaction. Same lang yung formula sa horizontal analysis. Now, here is the interpretation of RIA's merchandising income statement, because in horizontal and vertical analysis, the interpretation is very important. According to Sir Chuba in YouTube, wala daw saysay ang mga numbers na ito pag walang interpretation. That's why in analysis of financial statement, ang interpretation is very important. So here is it. The sales have increased at a higher rate than cost of goods sold, 20% versus 14%. This means that more sales activities were undertaken, which increased sales and at a minimal increase in cost. Gross margin and all operating expenses have increased due to the corresponding increase in sales and cost of goods sold. The profitability of the business has greatly improved in 2016 with increased net profit by 38.9%. So that is the horizontal analysis of RIA's merchandising income statement. So let's have example number 2. Horizontal analysis of a statement of financial position. Below are the statement of financial position for the years December 31, 2015 and December 31, 2016 of RIA's merchandising enterprises and the corresponding horizontal analysis and interpretation. So, it's just same in income statement, same lang ang content, which is the current year, prior year, the variance, and the percentage change. So, let's have the solution in next slide. So, here is the solution of RIA's merchandising enterprises statement of financial position for the cash only. So, the formula to get the variance, peso change is equal to current year minus prior year. So, RIA have cash in current year 235,000 and in prior year 185,000. To get the peso change, you need to subtract it. So, 235,000 minus 185,000 is equal to 50,000 pesos. So, 50,000 pesos is the peso change of RIA's merchandising enterprises for the cash only. And to get the percentage change is equal to peso change divided by prior year. So, 50,000, the peso change, divided by 185,000, the prior year, is equal to 0.2703, multiplied to 100, is equal to 27.03, and put the percentage sign. So, in conclusion, the peso change of RIA's merchandising statement of financial position for the cash only is 50,000 pesos and the percentage change is 27.03%. And to check, prior year multiplied by percentage change, which is the prior year 185,000 multiplied to percentage change, which is 27.02703%, is equal to 50,000, which is 50,000 is the peso change. And prior year plus peso change, prior year 185,000 plus the peso change is 50,000 is equal to 235,000, which is the 235,000 is the current year for the cash of RIA's merchandising enterprises statement of financial position. Here is the interpretation of RIA's merchandising horizontal analysis. The liquidity of the business improved in 2016. This is reflected by the increase in the total current asset compared to the decrease in total current liabilities. However, the increase in accounts receivable in 2016 means that the business must exert extra effort in the collection to avoid doubtful account expense, while the increase in the inventory in 2016 means that the business has to maintain stock of inventories where if not sold immediately will result to losses. Second, the solvency of the business also improved in 2016. This is reflected by the decrease in notes payable, which means that the business has honored the commitment in paying its obligation. And lastly, the main source of business financing in 2016 is capital, primarily from the profits rather than additional contribution by the owner. This is reflected in the increase in capital by 56.71%.
Hello everyone, I am Rina Joy Payet and I will be the one to discuss on how to prepare and get the vertical analysis of the income statement and vertical analysis of statement of financial position. But before that, let me share first what is vertical analysis. Vertical analysis is the proportional analysis of a financial statement, where each line item on a financial statement listed as percentage of another item. Typically, this means that every line item on an income statement is stated as a percentage of gross sales, while every line item on a statement of financial position is stated as a percentage of total assets. In simple terms, vertical analysis is a way to compare different items on a financial statement by expressing them as a percentage of a specific item. For example, on an income statement sheet, each line item is shown as a percentage of the total sales, and on a balance sheet, each line item is shown as a percentage of the total assets. In preparing a vertical analysis of financial statement and income statement, the formula that we will going to use is common size ratio equals comparison amount divided by base amount times 100%. Take note that the total assets and net sales will be the base amount or the 100%, and all of the items will be divided using the base amount. Will you please try to look the attached photo of income statement? So the following are the income statement information for December 31, 2016 of Leah's Merchandising Company with the corresponding vertical analysis including its interpretation. Your sales will be the base amount, which is the 3 million, and your cost of goods sold followed by gross margin, salaries, wages, office rent, and so on will be your comparison amount. So let's try to compute for cost of goods sold using the formula common size ratio equals cost of goods sold, which is the comparison amount, 1,600,000 divided by sales, which is the base amount, 3 million times 100%. So 1,600,000 divided by 3 million is equal to 0.5333 times 100% is equal to 53.33%, and that will be your common size ratio. So the interpretation for cost of goods sold is 53.33% sales, 53.33% of sales, which means that for every 1 peso of sale, 53 centavos represent the cost of goods sold. Likewise, the total expenses is 34.83% of sales, which also means that for every 1 peso of sale, 34 centavos goes to the operating expenses. In summary, after deducting the cost of goods sold, which is the 53.33%, and operating expenses, which is the 34.83%, only 11.83% is left as profit. The business can consider this information in making a decision like reducing the cost of goods sold to increase the profit. So the second example will be the vertical analysis of statement of financial position. So to find the common size ratio, again, can you please look the attached photo for a statement of financial position? So the following information are the statement of financial position for December 31, 2016 of Leah's Merchandising Company with the corresponding vertical analysis including its interpretation. So here in statement of financial position, we have assets, total liabilities and owner's equity, and owner's capital. Your total assets will be the base amount or the 100%, and the cash in assets followed by accounts receivable, inventory, total current assets, and fixed assets will be the comparison amount. To get the common size ratio for every listed assets, we will going to use the formula the same with income statement example. So the common size ratio, the formula is the common size ratio equals comparison amount divided by base amount times 100%. Let's try to compute for cash and assets. 235,000, which is the cash, divided by 1,913,800, which is the total assets, is equal to 0.1228 times 100% is equal to 12.28%, which is your common size ratio. The same with total liabilities and owner's equity, that will be your base amount or the 100%, and your comparison amount will be the accounts payable, accrued liabilities, total non-current liabilities, and so on. So to get the common size ratio of accounts payable, you have to use the same formula, which is the common size ratio equals comparison amount divided by base amount times 100%. So 155,000 divided by 1,913,800 is equal to 0.0604 times 100% is equals to 6.04%, and that will be your common size ratio. So the interpretation is the resources of the business are tied up to inventory, which is almost 25% of the total assets, while the accounts receivable is also about 19% of the total assets. The business can consider this information as a go signal to improve the collection effort and manage its inventory. Also, the business can consider to settle its notes payable to avoid interest expense and improve its profitability. So this, I mean, before I end my part, let's go back to vertical company financial statement analysis. So, the most common use of vertical analysis is within a financial statement for a single time period, so that one can see the relative proportions of account balances. Vertical analysis is also useful for timeline analysis to see relative changes in accounts over time, such as on a comparative basis over a 5-year period. For example, if the cost of goods sold has a history of being 40% of sales in each of the past 4 years, then a new percentage of 48% would be a cause for alarm. In simple terms, vertical analysis is a method used to analyze financial statements by comparing the relative proportions of different account balances. It helps to understand the changes in account balances over time and identify any alarming trends. For example, if the cost of goods sold has always been 40% of sales in the past but suddenly increases to 48%, it could raise concern.
The following are the information for the years December 31, 2016 and December 31, 2017 of Ditdit's Merchandising Company, for which you are required to prepare an income statement and the horizontal analysis including the interpretation. Solve for the gross profit, general administrative expense, selling expense, other expense, net income, and prepare an income statement. After that, make a horizontal analysis. The following are statement of financial position for 2016 of Venice the Explorer Merchandising Company, which you are required to prepare a statement of financial position and a vertical analysis including its interpretation. That's all. Thank you.